This triple net lease world with national tenants is a unique market. It's all in its own class, and it's fascinating to watch, but it's also great because the prices haven't changed a lot. So unlike multifamily or other stuff, interest rates go up. That affects the price big time.
From cornfields to high rises, office to industrial, houses to hotels, and every other asset class in real estate, we cover the people, the projects, and the profit. Welcome to the Investing in Iowa show. This show is for go-doers, action takers, and business owners. It's for people like you who are sick of Uncle Sam taking a huge bite of your apple. If you're looking to get ahead of what's taking place in Iowa, learn who is doing what, and how you can get in on the action, you're in the right place. Hosted by Neil Timmins, an Iowa native who has been involved in over $300 million in real estate right here in Iowa. Recording in studio from West Des Moines. Here's your host, Neil Timmins.
I've got Tom Rauen here. Tom, welcome to the show.
Yes, glad to be here.
I'm excited you're here. Say for the audience to say, who are you? Where are you from? What do you do?
All right. Live in Dubuque, Iowa, and pretty much been there my entire life. Went to the University of Dubuque and CEO of 1-800tshirts.com and Round Capital.
I'll tell you what, Dubuque is beautiful for those who haven't been there. I know what it can attract you to that. It's just kind of rolling hills overlooking the river. It is an incredible place, especially when you spend time in other sections of Iowa. A lot of it's flat, and Dubuque just doesn't look like Des Moines. So I know there's a lot to like there.
Yeah, I love it. It's beautiful. It's gone through a lot of kind of changes throughout my life. So it's fun to be part of those changes and see it all happen.
Talk to me about your very first real estate investment. What was that?
Yeah, it was a nightmare. And so I bought a fourplex that also had some storage units behind it. So I believe it was roughly about 20 storage units and then the fourplex. This was in a very rundown, I would say rough part of town. And I bought it on contract. I'd gotten, I think it was like $3,000 or $4,000 of inheritance money when my grandpa passed away. And so I used that as a down payment, and I was in the game.
Yeah.
And then we quickly realized, one tenant was a pretty heavy drug dealer. Mm. Another tenant was a hoarder. Another tenant, I'm not sure what they did, but there was basically cops there a lot. Oh. Every possible scenario that could have happened, we went through in the first year, and it was just absolute nightmare. Ended up evicting everybody, remodeling the entire place, and then selling it. And actually did pretty well on the sell of it. We, got pretty fortunate on that part of it. Learned a lot of lessons. Yeah. And the biggest lesson I learned was I don't want to deal with tenants anymore. So that forced us into the commercial side of things.
When you say tenants, more specifically, you mean people,
individuals,
rentals, houses,
people.
Apartments.
Yeah. I don't want to deal with people and phone calls and all that sort of thing on the weekends and just all these issues. So that forced us into commercial. Yeah. And then I learned about triple net lease, where the tenant covers all their maintenance. They cover the taxes and insurance and everything else. And with, owning a company, that's my full-time, job, that I didn't have time to be dealing with all the extra stuff. So I knew that if we wanted to keep growing this thing, we really had to focus on an asset class that was very passive, very hands-off. And that's how we kind of landed in this triple net lease world and, focusing on that asset class.
For a time reference, when was that first transaction?
That was 2009.
Okay. Got it. You've got a full-time job. You run a successful business. At some point, it sounds to me, and correct me if I'm wrong, that you've got dollars and cents to place, like so many successful business owners. And your choice oftentimes becomes, first, invest in your own business, without a doubt.
Yep.
And then second, when you've got excess capital, most people, turn to the stock market, that quote unquote, the traditional avenue for investments. And for lots of folks, certainly business owners, those who are accustomed to being a little more hands-on and creating their own success, real estate becomes a very viable option for them. And how'd you go down a real estate path versus a stock market path, for example?
Hi, it's Ava Boukamp, the Investment Relations Manager for Neil's firm, Legacy Impact Investors. I'm inviting you to join us for our next investor workshop, our monthly legacy briefings. In these tactical Zoom calls, we cover topics and case studies for subjects such as taxes and depreciation, navigating macroeconomic shifts, and evaluating deals as a passive investor. At each virtual workshop, we are joined by an industry guest who covers their topic in 45 minutes or less. No fluff, no pitches, just education and conversation with an expert each month. Every workshop ends with live Q&A from Neil and our guest. All briefings happen on the last Tuesday of the month at 3 p.m. Central. If you can't make it live, recordings are sent out exclusively to those who've registered in advance. To join us on the last Tuesday of this month, visit legacybriefing.com. Go to legacybriefing.com to register. If you're a first-time registrant, I'll send you a free resource at sign up. Head to legacybriefing.com and I'll see you soon.
So I remember reading a lot about how, a lot of wealthy people had built it up through real estate. And I never really thought about it now until you just pointed it out. But 2009, 2010, basically I was starting this journey. And I remember seeing my parents then, and then also in the, late 90s, when everything dipped, their basically 401ks, their entire retirement savings. We had the financial advisor that come over to my parents' house, sit down at the kitchen table and tell them where, basically their retirement was at. And I remember the one time basically got wiped out, or, more than half. And I was like, how can this happen?
Right.
I don't want that to ever happen to me or our family. Yeah. And, with real estate, I was looking and say, all right, I can see the building there. It's physically there. Over time, it's always going to go up in value, and at some point, you look at values 10 years ago or 20 years ago or 30 years ago. And I remember my grandpa telling me, he said, land that they won't make any more of it.
Right.
Always invest in land and properties and whatever you can.
Yeah. Incredible. So you get eventually turned on to triple net leases. Tell me about the first property you acquired there.
Yeah. So the first one actually was the building that we were looking to put the t-shirt company into. Yeah. So that was the first commercial building, and we basically house hacked it. So I remember, listening to a podcast or something, and it was like, buy duplex, live in one side, rent out the other side, and let that, cover your bill. And so we found this building, commercial building. And at the current time, the t-shirt shop business was in 2,000 square feet. This building was 12,000 square feet. Like, it was just way too big for us. So it had been on the market. It was a former Rex appliance store.
Sure.
And so it was dark for a couple of years. And I looked at it, and then I was like, no, it's way too much. It's too big of a project. There's no way. And the price was just too much at that time. It was like, this is not going to happen. Yeah. And then I think it was like 8 or 10 months later, looked at it again, and I kept thinking, all right, how can I make this happen? Or what can we do? And the more I looked at it, I thought, all right, if we don't need 12,000 square feet, that's a crazy jump from 2,000, 12,000 with our business. But I thought, all right, if we subdivide this, we take 7,000, and then we've got 5,000 left. We'll do that into 2 storefronts of 2,500, or if we find a tenant at the 5,000, then we're good. And, I calculated the, mortgage payment was going to be about 5,000 a month.
Okay.
And so I thought, all right, this is it. This is the house hack.
Yeah.
We just got to find a tenant, and I have to find a bank to believe in the vision here of how we're going to take this building, redevelop it, and make all this work. And then the idea was, after, maybe a 5-year lease or something was up, if we were expanding, we would just, expand into the entire building and not renew the tenant's lease at that point. Yeah. So luckily we get the deal done, and we're getting ready to move in, getting it subdivided and stuff like that. And a local fitness place reached out, and they want the entire 5,000 square feet.
Beautiful.
I was planning on a year process, and it actually, this happened within a couple of months.
Wow.
And so they're still there today, and, covering that mortgage payment. And I was like, this is so great. It was perfect. So that was 2012. And when we acquired that, and then we just sold that property. And so we acquired that property for $650,000 in 2012. And we just sold it in 2021, actually 2020, right in the midst of the pandemic. And we sold it for $1.65 million.
Wow. That's incredible. And house hacked it the whole way.
Yeah.
Yeah. I'm curious about your entry. How much money did you end up out of pocket when it came to the loan and any sort of reconstruction, roughly?
Yeah. So the down payment, we did an SBA loan. So we did 10% down, $65,000.
Yep.
And at the time, we scraped together, I'm talking everywhere we could find extra pennies to get the $65,000. We actually pushed the closing out. We extended it, I believe, 5 different times. And, looking back now, I'm like, wow, I cannot believe they kept extending for one. And we were still able to get that deal done. But yeah, it was just kind of scratching together whatever resources we could to make it happen. And then the kind of redevelopment, I believe, was around $200,000. And so we got it done. And then the tenant came in and they did all their own TI.
Okay.
Which was great. So everything just kind of worked out well on that deal.
When you're a small business owner and you're making things happen, especially early in your career, early in the business, you got to get scrappy. You got to find grit. You got to find a way to get through it.
Yeah.
Yeah. That's incredible. All right. So you move on from that. Talk to me about how the portfolio, what's been the focus since that? You learn how to do it, you execute it, and then at some point you go, cool, let's go buy something. Let me bring in some investors. You're leveraging what you learn and the resources, not just dollars, but really the connections, the network that you have to go take down additional property.
Yeah. So 2015, we got our first triple net lease. And it was kind of the same thing. We had outgrown the building pretty quickly. Yeah. And instead of kicking the tenant out like I initially planned, I said, well, let's just let them keep paying rent. We'll find a bigger building and then we'll lease this out and it'll be a, income producing property for us. And so I found a big warehouse in the industrial park, and the owner had sold to private equity, still owned the building. Private equity didn't want the building because they didn't want to be tied to the real estate. Yep. And so we acquired that, and the idea, and they had 4 years left on their lease. It's kind of a risk, but the idea was if they move out in 4 years, they've paid it down 4 years of equity in it, right. And then we moved the t-shirt shop there. So that was our hedge on this property. Well, 2.5 years into it, they re-signed another 10-year lease and extend it, and then we looked at that hedge as, okay, now we have the cash flow from this property that we can then use to purchase another one, and the equity built up in both of them to use towards the down payment in another property. So then 2018, we purchased the current building that we're in with the 1-800 t-shirts, 35,000 square foot building, and largely, paid with the equity from the first 2 properties and the cash flow from them for the first year just to cover that. So it was, almost like an additional, house hack in there where the tenants of the other properties were helping us grow the t-shirt business there. That same year, we had a banker come to us. There was a local investor who was having some health issues, and they had a BioLife plasma building, another triple net lease, and acquired that one. After that one and having the other industrial one, it was like, wow, this triple net lease is really nice because it allowed us to still focus on the day-to-day business and be able to create this passive income besides that. So had those, learned about, Dollar Generals and Starbucks and Arby's, and all of a sudden start discovering that when you drive down the street, all these corporations aren't owned by, the real estate isn't owned by the actual corporation.
Correct.
And I watched the movie The Founder.
Yep.
And I'm like, okay, that's how McDonald's, built their empire, which now I think McDonald's owns maybe 40% of the real estate.
Right.
And once that opened my eyes up to that, COVID was like, okay, we see this here. There's a lot of opportunity here. A lot of people are going through different transitions. And I think other people need to know about this. I mean, everyone I talk to, like, wait, you own a Starbucks and an Arby's? Like, how does that happen?
Right.
And I started explaining it to them. So now it's after COVID, I was like, all right, I have to not only explain this to other people and let them know about it, I should bring them in as investors as well, because a lot of these properties are ranging from $1 million to $5 million each.
Right.
And for a typical person, they just don't have, a lot of money to take one of these down on their own. But if we pool together, 5 or 10 people, 25 to 75,000 or 100,000 each, that's a little bit more digestible for people. And then they can diversify across several properties.
Right.
And so we started syndicating a few, bought some Starbucks, and a few other, properties like that. Yeah. And then everything kind of from there really started taking off. So I'd say 2021, 2022 were some big years. I mean, that's when it was like, all right, we're doing this. We're putting the foot on the gas and going. 2021, we acquired, I think it was 8 properties. We were up to almost 1 a month. Yeah. And then in 2022, we did 7. 2 big back-to-back years, kind of just right out the gate. Yep. And then we hit all the changes.
We hit all the changes.
2023.
Yeah. COVID was, challenging in a lot of regards, but very positive in a number of regards in the business world, and the ability to make some moves, to strike. Interest rates were very favorable. There was a lot of positive things, a lot of opportunities presented themselves, and then eventually that music stopped and interest rates moved very hard, very fast the other direction, and really choked a lot of that opportunity out of the marketplace.
Yeah.
What has it been like, and what's it been like since, for the last 2 years, let's say, since interest rates have really moved, and what are you guys executing on now?
Yeah. So this triple net lease world with national tenants is a unique market. It's all in its own class, and it's fascinating to watch, but it's also great because the prices haven't changed a lot. So unlike, multifamily or other stuff, interest rates go up, that affects the price big time. So on these, we're competing with big hedge funds, private equity, people are doing 1031 exchanges, insurance companies, whoever, and they're paying all cash.
Right.
So they don't care if the interest rate's 3% or 10%. When they're paying cash, it's there. So these are holding their value, which is great for our existing portfolio.
Yes.
But at the same time, there's an inverse on the cap rate versus the interest rate right now. So
said differently there, you've got inverse, you've got negative leverage.
Yeah.
Meaning you're borrowing at a higher rate in which you can employ the dollars and cents.
Yeah.
Okay.
So we can't leverage the way that, we can't get that spread to have the cash flow.
Right.
And leverage the way that we used to. So now it's, all right, how do we do this differently? So a few things we're looking at right now is value add. So how do we go in? We've got the vision, the creativity and stuff to look at a building and say, all right, well, there was an old owner here that is old and tired. He doesn't want to put time into it or doesn't see it. We can maybe see the vision of this is a great thing. Maybe it's cosmetic fix-ups. Yeah. Maybe it's a different tenant mix, and add that value to it. Some other options right now we're looking at is owner financing. So how do we, if an owner is stuck on a price, and it's been sitting for a while because they don't want to lower their price, especially on a multi-tenant building, we can still get that deal done at their price. However, they've got to go at the term. They got to finance at the terms.
You name the price. I name the terms.
Yeah. And so we've got a deal done last year, where the seller carried at 4.5%. And we were able to still get them the price they wanted. And so it worked out in a good deal for both sides. And so we're just looking for those types of deals where we can, still get that spread, still get the cash flow that's going to have those returns and, find nice properties like that.
What are you most excited about this year, 2024?
I think it's taken a lot of people out that are not willing to put in the work. So 2021, 2022, it was just like deals coming left and right. Yep. And competing on those deals. I mean, people just bidding on them, and it was it was crazy. And I think any novice investor could have just got in the game, done some deals, and it didn't matter. Now it's like there's more work to do. It's like, all right, we got to analyze this a little differently. We've got to look at it differently. We've got to create creativity and say, all right, what do we do to reposition this property? How can we increase the rents? How can we get different tenants in there? How can we get creative on the financing structure? So it really just takes a lot more on the back end, and some people aren't willing to put in that work. So I think it changes the playing field a little bit when others aren't willing to do the work.
If you're a house flipper, execute the burst strategy, or do double closings and are in need of money, Little Guy Loans is your go-to lender here in the Des Moines area. Time is money. Loan approvals in 24 hours. Closings in 5 days. Little Guy Loans was founded by Neil Timmins, an investor just like you. Since he has been in over 10,000 homes in Des Moines, there's never an appraisal. Houses, multifamily, and commercial property loans up to $1 million. Check out www.littleguyloans.com.
I'm wondering, on a forward basis, I saw this in the housing market in 2011, 12, somewhere in that range, or through that range, is what you just said. They're not willing to put it in the work. The players, a number of them just go away, especially if you're on the acquisition side of this industry. Your comp is tied to acquisitions. The number of acquisitions you're making has dramatically reduced. You just find something else to do. So where I'm going with this is, I wonder what that looks like when we get through whatever it is we're going through right now. When we get to the other side, and instead of year over year, the velocity of deal flow falling, that all of a sudden it comes back and we're on an upswing again. Do people like you and the rest of the players who stick around, who grind through it and work through it, are they the benefactors of tremendous opportunities on the other side when it swings upward because you're here, you're doing the work day in and day out?
Yeah, I mean, so the ones that either get out of the game or are sitting on sidelines right now, I foresee any deals that people are getting done or we're getting done right now, if they're cash flowing and they're, we're making the numbers work right now, that deal's only going to get better in the future. So whether rates go down or values increase or more people are coming in a couple of years when, there's more favorable financing or whatever the case is, those ones that we're locking up right now are going to look really good.
Yeah. What are you seeing when you talk to banks? What kind of feedback are you getting right now?
They're getting very stringent on what they're lending for. So if they're in a liquidity crunch and they've only got a certain number of dollars to lend out, they need to make sure it's a grand slam. They can't have any duds in there. They can't have something fall through. They're borrowing money at a higher rate than what a lot of our loans are at, right?
Sure. They're the ones on the books. Yeah. Right.
And so they're looking and saying, all right, well, is my money better just invested in, with the Fed right now,
right?
Essentially.
Keep it in bonds, right?
And having a safe return versus, putting it out there. So it's an interesting time to see that. And I think you kind of learn where those relationships go right now. Also, the bank's got to put in the work, right? They've got to be able to see the vision. They've got to be able to creatively see past their standard underwriting. So sometimes it's, a banker gets stuck in like, here's our underwriting standards, and they're going through and there's no leeway at all. And I think right now, to keep deals kind of going, they've got to look at it and say, all right, well, is there exceptions to the underwriting? Can we see something beyond, just what's black and white? And I think those are the banks that, could end up with some nice, properties, assets in their portfolio, and also create long-term relationships, because right now, it's the ones that are willing to maybe stick their neck out there a little bit, work with you. It's very meaningful for the investors, for those clients to say, all right, these guys helped me out when all the other banks were closing their doors for us. And that's, going to be a long-term, kind of just reciprocity there.
All right, you're seeing the same thing I'm seeing, is that a number of banks, they have liquidity challenges, they're in unique spots, and underwriting it's fair to say, has gotten tighter in a number of regards. Money from a bank standpoint is flowing less than what it did a couple of years ago. you're seeing that too.
Mm-hmm.
So going back to what you said earlier, I agree with exactly what you said earlier, which was if you can get a deal done today and it works and it cash flows, it pencils, that it's going to be a much better deal at some point in the future. So much of this industry, the backbone of this industry is debt, right? 70 cents plus or minus of every deal is a debt dollar in one capacity or another. So as things get tighter, they get more challenging, like they have been since rates have gone up. There's, ultimately prices should fall. We're seeing that in some spots, but as you said, in other spots, such as triple net, they haven't. But other asset classes, they have. And when dollars get looser, lending loosens, there's more dollars moving, prices improve, right? Prices rise, it gets more competitive. So long term, I agree with exactly what you said. And that's why I asked the question, what your experiences were with the bank standpoint. To echo what you're saying is that get it done today, it gets better tomorrow.
Yeah, 100%.
For you, why Iowa? You have, born and raised here, but certainly you've got the choice, freedom, flexibility, a thriving t-shirt business. You could locate this anywhere you choose to do so. You choose to do it here. Why?
I just like everything about Iowa. I grew up here. I'm familiar with it. I like the people, and I like everything that's happening. And I think, looking at whether it's trends in the t-shirt business or real estate business, like whatever business it is, we're kind of in our bubble, and I call it the safe bubble because like on the coast, if you look at, 2009, 2010, that the coast just got hit hard. And then you look at big cities and major metropolitan areas, and they're just getting crushed because there's just so much volatility and ups and downs. And I feel like in Iowa, we're in that space that by the time we realize there's this big catastrophic thing happening on the coast, it's already done and over. And it does. And for us, it's a minor speed bump instead of a big mountain that just happened. And I like that, for a lot of outside investors, guys that are investing from California, New York, wherever, it might not be sexy for them. And I like that because it's our own little secret here, so it's like, all right, we know it. And, I'm familiar with it. So especially the stuff in Dubuque, I'm like, all right, I not only know that property and know the history of it and know the former owner or something, but I also know all the tenants. So I know the people that are running the business in there. I know the guy that's running the pizza shop, the nail salon, and everything else. And I'm familiar with them. I'm comfortable with them. And I know, they're going to be great tenants, things like that. And if they don't, I also know Bob that has this business over here, and he might like to be in that spot. And so just having all that familiarity makes it a lot simpler on the taxes, whether it's property taxes or everything else. It just keeps it simple. I know when they're due. I don't have to keep looking up different schedules and everything else. When everything is, because I get brokers and they say, well, what if we had a property in Missouri or Indiana or somewhere else? I'm like, well, that's fine, but there's still so much opportunity here that I like to keep it simple. And that's like my main kind of model and focus with all this is I've got to dedicate a lot of time to 1-800 t-shirts. And then I dedicate a lot of time to our family and kids. And so I don't want real estate being like that first nightmare with the fourplex where it's sucking all my time and energy. And so I look at what a lot of people probably don't view. They always are just looking at ROI. What is my return on this investment, right? And so I always look at ROH, return on hassle, and return on headache, right? Like just keep it simple. I don't want headaches. I don't want a lot of hassle. How can we simplify the whole thing? And so that's where just the big focus in Iowa comes from that.
It's great. I'm going to add one more to you. You can use this ROT because this is what I look at. What's the return on the time, right? That's in the same vein as the ROH. Yeah. Takes a lot in some cases to get that return.
Yeah.
You ready for the final 3 questions, Tom?
All right.
If you had one piece of advice for your 20-year-old self, what would it have been?
Get in the game, get off the sidelines. You can read books, you can listen to podcasts, you can do all the things, but until you're in the game and, actively doing it, you might learn a few hard lessons, but it's worth it because that's part of the education of it. Yeah, but that education you can't learn in a book or on a podcast or something else until you're actually in the weeds, making it happen, and learning the real world, what's happening as you're in it. So I would say, save up enough to get in early. If you can't get in on a property on your own, invest into a syndication with somebody else, a good operator, because then you're in the game. You're not necessarily doing all the heavy lifting, and the GP on that syndication can also be a great mentor and help, navigate everything that's happening.
For a lot of folks, that is the absolute best way to go.
Yeah.
2 books that changed your life.
Rich Dad, Poor Dad, of course, because that got me in the game. That was the kick in the butt of like, you got to do this and got to get in there. Yeah. And the other 4-Hour Workweek. If
you were cast away on an island for a year, you could only get 3 pieces of data about your real estate business each month. What 3 things do you need to know each month about your real estate business to know how it's running?
Rent roll. And I really don't need that much data. I know Starbucks is paying rent every month.
Because it's a triple net.
Yeah, it's real simple. So I don't have to worry about a lot of expenses coming through.
Yep.
I trust our national tenants, Starbucks, Applebee's, Arby's, FedEx, they're all paying rent, and it's ACH just going into the bank account. So, a lot of times just watching the bank account, and there's not much to manage. Yeah. So I don't need a lot of data, beyond that.
Tom, I've asked lots of questions. I'm certain we could talk for hours, but we will not. But what's one question I did not ask that I should have asked?
What's next?
Oh, let's hit it.
So what's next is we're going to keep growing. We're going to keep looking for properties, keep kind of just having fun with it, and keep educating and bringing other people into the space as well. I think triple net lease and commercial real estate is a great alternative to the stock market and traditional 401ks and things like that. So I think getting people the opportunity to invest and, getting them out of the rat race, maybe to retirement a little bit quicker, and getting the passive income opportunity that I didn't have when I was younger is a great thing that we can do for the industry.
It's been a great conversation, Tom. I appreciate you. You came in from Dubuque, drove to West Des Moines here to be in our studio, and I appreciate you making the journey, taking the time. This has been a great conversation. For people who want to find you, they want to follow you, they want to connect with you, where can they go? What should they do?
You can follow me on Instagram at Fast Food Landlord, or on Twitter at Invest with Tom.
Links are below in the show notes for everybody. Tom, thanks for being here.
All right. Thank you.
Thanks for listening. If you're enjoying the show, may I ask a favor of you? Naturally, subscribe so you never miss an episode. But would you rate and leave an honest written review on Apple Podcasts? It does a lot for us here at the show, and I appreciate reading your thoughts. Great guests make for a great show. If you know of another Iowan who would be a great guest, or you yourself have interest in being a guest, well, get on our radar. Visit Investing in Iowa to fill out an application or recommend a guest. And if you want to connect with me one-on-one, go to LegacyImpactInvestors.com. Click on the Invest With Us button in the top right corner, and there you can pick a time for the two of us to get on the calendar and connect. Until next time, keep investing in Iowa.